Welcome back. Investors and consumers alike are worried about a looming trade war between Canada and our largest trading partner, the U.S., with U.S. President Donald Trump promising to deliver on his threats to impose tariffs on imports from countries such as Canada. Our next guest is keeping an eye on how a weaker consumer could affect the overall economy. Royce Mendes is Managing Director and Head of Macro Strategy at Desjardins. Royce, thanks a lot for joining us. There's been a lot of talk on the tariff front. We have tariffs on steel and aluminum already in place. What is your take on what's happened so far and where we're going on this trade war story?
I think it's really hard to say where we're going to end up. I don't think anybody knows where we're going to end up, whether this trade war keeps escalating or whether we can find some sort of solution to de-escalate and come to an agreement to maintain free trade with the U.S., because that is of vital importance. So, I think everyone is justifiably focused on the downside risks. What if we get hit with those 25% tariffs across the board for the whole economy? That would push us into a recession. It's pretty clear that that would be the result of those types of actions from the U.S. But, I want to point out that there is a way to look at this from an optimistic point of view, that, if we get the right type of people at the negotiating table, if we put the things forward that Donald Trump is looking for, maybe we can maintain free trade with the U.S. and maintain this relationship that has worked for both countries so well for so long.
Another thing you're watching closely, and you've got some interesting insight in your most recent notes, is the mortgage renewal situation in Canada. I think viewers know what we're talking about. 5-year mortgages that were initiated at quite low rates of interest, and they need to be renewed either in 2025 or 2026 at rates we presume that will be significantly higher. You make the point that the evidence already shows that some mortgage holders in that position are falling behind on other debt as they perhaps struggle to meet their monthly mortgage payments. And this is before many of them have renewed at higher rates. Where does that situation stand now, Rhys, and how significant is the potential for further pressure on consumer spending in Canada?
Well, the question is whether, if some households are falling behind on credit card payments or lines of credit or installment loans, whether that is the canary in the coal mine for then a big rise in mortgage arrears. At this point, I think that there is a path forward where that doesn't happen, but it really includes the Bank of Canada continuing to cut rates regardless of what happens on the tariff front. Look, up until this point, the mortgages that have been renewing were taken out pre-COVID. Generally speaking, as we move forward in this year, we'll get to a point that the majority of mortgages that are renewing will be the ones that were taken out in 2020 at rock bottom rates. And we'll see that continuing as the year progresses and into next year. These are the mortgages that are most at risk of seeing very large payment shocks, particularly the people who took out the variable rate fixed payment type of mortgage product. That is a big concern on our part, but we think the Bank of Canada thus far has done exactly what it needed to do. When a lot of people were saying that interest rates weren't going to come down, or when they did, they were only going to come down a little bit, we had looked at this mortgage market in Canada, done the analysis, and figured out that the Bank of Canada had to cut aggressively coming into this year to keep a lid on arrears. And they're going to have to keep cutting, not as aggressively as they did around the end of last year, but they're going to have to keep cutting. I think they get to a rate around 2% on the policy rate, and that's enough of some sort of trade war shock to keep consumers and mortgages in a healthy position in this country.
I believe I hear you saying that the Bank of Canada explicitly understands in its internal discussions that one of the reasons it needs to continue cutting rates is to give these people renewing their mortgages a little bit more wiggle room.
Yeah, I think that's fair. They don't talk about it a lot in their public communications, in the monetary policy report or in their interest rate announcements, the statements that accompany it. But where they have focused a lot of attention on the mortgage market is in the financial stability report. And the analysis that they provide there, the type of numbers for payment shocks that are upcoming that they provide there, look a lot like the analysis that we have provided for some time to our clients. And that gives us some sense of comfort that, number one, they know what is coming in terms of the payment shocks. And number two, that the work we're doing lines up with the numbers that they have, because they have access to the loan level data. We're using aggregate data from that's publicly available. They're using loan level data, and if they're coming to the same numbers, then they know exactly how much of an issue this could be for a subset of Canadians this year and even into next year.
Let's talk about immigration. What are the consequences to the economy of the significant pullback in various streams of non-Canadians entering the Canadian population and workforce or study force?
I'll say right off the bat that businesses across this country are worried about this pullback in immigration because, anytime you grow the population, you grow the number of consumers there are to buy the goods and services that businesses are selling. So, corporate executives are worried about this. What I'll say here is that if you look at the numbers, where we're seeing the population shrink is in temporary residents, particularly international students. Those students didn't drive a big increase in spending when they came in 2023 and 2024. They don't have high incomes. They're not working a lot, if at all. And so they're not spending a lot. So subtracting them is not going to be a sort of major issue for a lot of businesses. Most businesses, what they need to bank on this year is that Canadians who have been here for a long time, or even immigrants that are a little bit older in their prime age that have come here, continue to spend and spend more than they did last year. That'll be driven by stability in the employment market. Hopefully the unemployment rate continues to come down. And it'll be driven by inflation remaining low, because that's going to allow people to spend on more things and not just be stuck buying the essentials at very high prices. Again, the key here, we think, is that interest rates need to come down, not only to keep people's mortgage payment shocks manageable, but also to allow people to spend a little bit more in the economy overall to support these businesses that could feel at least a little bit of pain from the slowdown in population due to the reductions in temporary residents.
Royce, thank you so much for this. Royce Mendes, Managing Director and Head of Macro Strategy